Welcome to the deep dive. If you're here, it's probably because you, like us, crave clarity. You want to understand the intricate world around us, especially when it touches something as personal and, well, profound as your financial future.
Absolutely.
The stock market, for many, often feels like this formidable, bewildering maze, right? Full of complex charts, whispered tips, and jargon that seems designed to keep the average person out.
Oh, definitely. It can feel incredibly intimidating, leaves a lot of people feeling unsure where to even begin.
Yeah.
That feeling is incredibly common and, for good reason. The sheer volume of information thrown at investors daily, the constant fluctuations, the endless parade of expert opinions and sophisticated strategies, it's genuinely overwhelming. It often feels as though you need like a specialized degree or an insider's network just to decipher the basic moves. The noise can be deafening, making it incredibly difficult to spot the signal.
Well, today we're cutting through that noise. Our mission in this deep dive is to offer you a refreshingly direct shortcut, an exploration into a truly remarkable little book that promises to demystify stock market investing entirely.
A little book with a big promise.
Exactly. It presents a surprisingly simple yet profoundly effective strategy. And yes, it boldly claims you can not only navigate the market yourself, but actually beat the market without needing to become a full-time financial analyst.
Which sounds amazing, right?
It really does. We're going to unpack exactly how that's possible, diving into some surprising facts and insights, all while keeping it engaging and, dare I say, a little fun. This is going to be a fascinating journey.
And the mind behind this remarkably accessible yet powerful work is Joel Greenblatt. Now, for those who follow the investment world, his name is synonymous with deep value investing and, frankly, impressive success.
Right? He's got the track record.
He really does. What's particularly compelling, though, is his personal motivation for writing the little book that still beats the market. It began as a heartfelt gift to his 5 children.
Wow.
Yeah, he deliberately crafted it to be so straightforward and logical that even his 6th and 8th graders could grasp its core concepts.
6th and 8th graders. Okay, that tells you something.
It really does. The commitment to simplicity is absolutely key here, and it truly underscores its inherent accessibility for you, our listener. I mean, if these foundational principles can be understood by a middle schooler, then they are certainly within your grasp.
That origin story alone makes you lean in. It highlights the intention behind the book to empower anyone. So what exactly is this audacious core promise of the magic formula he introduces? What makes it so special?
Okay, so the core promise, while audacious, is rooted in fundamental logic. Greenblatt doesn't just present a formula. He asserts that it's a magic formula that is not only profoundly simple, but also makes, intuitive sense.
Right.
With this framework, he claims you can consistently outperform or beat seasoned professional investors and academics alike.
Beat the pros.
Seriously. And what's perhaps even more surprising is that it can be achieved with relatively low risk, especially compared to the volatile swings often associated with market outperformance.
Okay, lower risk, higher returns. That's the dream.
It is. And the remarkable beauty of this, in Greenblatt's conviction, is that it works even if everyone knows about it. However, and this is the crucial caveat he emphasizes repeatedly, it only works if you, the investor, truly understand why it works and deeply believe in its underlying principles.
So it's not just following steps blindly.
Not at all. That intellectual conviction, he argues, is the true bedrock of success. Simply following the steps without understanding the logic is, well, a recipe for abandonment when inevitably faced with short-term challenges.
And he took extraordinary steps to ensure that conviction could translate directly into practical action. I read he was so genuinely concerned that readers might miscalculate or maybe rely on bad data from questionable online sources.
Yeah, exactly.
That he actually created a free online resource, magicformulainvesting.com.
He did. It's specifically designed to provide accurate calculations and high-quality data, removing common barriers and potential pitfalls for the individual investor.
That proactive move really highlights his dedication to ensuring that you have the right tools and reliable information to implement the strategy he's laying out with confidence. It's a rare and powerful commitment from an author.
It absolutely is. It's a testament not just to his belief in the system's efficacy, but also to his desire to democratize intelligent investing. He recognized that while the concepts are simple, accurate execution is paramount, and he provided the means for that.
Okay, so as we embark on this deep dive into the little book that still beats the market, what can you, our engaged listener, expect to uncover?
Well, we're going to guide you through a bit of a paradigm shift, showing you how to view the stock market not as an unpredictable beast governed by complex algorithms, but as a collection of actual businesses whose value can be rationally assessed.
Right, thinking like a business owner, not just a stock trader.
Precisely. We'll expose why so many, both individual investors and even seasoned professionals, often fail to achieve consistent success, which is a common source of immense frustration for people.
Definitely.
Most importantly, we'll equip you with a fundamental understanding and the practical step-by-step method to identify good companies trading at genuine bargain prices, and ultimately, how you can systematically work towards beating the market on your own terms.
All right, let's unpack this with the author's own brilliant starting point. Our journey into investment wisdom kicks off with a captivating story, not from a Wall Street boardroom, but from a 6th grade classroom. It's about a young entrepreneur named Jason, and he's making a surprising fortune selling gum.
Yeah, Jason's business model is wonderfully simple, yet incredibly illustrative of fundamental economic principles. He purchases packs of gum for 25 cents each, right? Each pack contains 5 sticks.
Okay.
His ingenious move is that he then sells each individual stick for 25 cents.
Whoa, okay. That's a markup. It's huge. For every pack he buys, he generates $1.25 in revenue, 5 sticks at 25 cents each from an initial outlay of just 25 cents. His pure profit per pack is a staggering $1.
A dollar profit on a 25-cent investment.
Exactly. Now imagine a 6th grader managing to sell 4 or 5 packs a day during school hours. That translates into a significant amount of money for a child, far more than typical allowance.
It's an almost unbelievably high-margin business, and the calculation of his potential earnings is truly eye-opening. According to Ben, the author's own son, who serves as a kind of stand-in for the listener throughout the book.
Right, Ben asks the questions we'd ask.
Yeah. Jason is raking in around $4 a day, 5 days a week, for 36 school weeks out of the year. That's a tidy $720 annually. And if he keeps this up, reinvesting his profits, by the time he graduates high school, he'll have amassed somewhere north of $4,000.
Which, for a kid starting from scratch, that's a serious chunk of change, representing significant financial independence at a young age.
No kidding. This simple scenario sets the stage for the book's foundational investment question, posed directly to Ben. If Jason offered to sell you half of his business, how much would you pay?
Okay, interesting question.
Ben, initially, has some very intuitive human responses. He immediately dismisses the idea of paying, say, $1,500 to get back $1,500 over 6 years. As he rightly points out, what's the point? You're just breaking even over a significant period without accounting for the time value of money or any risk.
Makes sense.
But then, almost reflexively, he declares that if Jason offered to sell half the business for just $1, he'd jump at the chance.
Of course. Who wouldn't?
Right. This initial reaction highlights a natural human understanding of value and the undeniable allure of a significant discount.
And then comes Ben's more calculated, considered offer. After he really internalizes the value, he lands on $450.
Yep, $450. And this is the profound aha moment that Greenblatt wants you, the listener, to grasp. This entire exercise of evaluating Jason's gum business is fundamentally about figuring out what businesses are worth.
It's not about charts or trends. It's about the actual business.
Exactly. It's not about complex algorithms, insider information, or predicting market sentiment. It's about understanding the intrinsic value of an underlying enterprise, what it generates, and its future potential.
Okay.
Precisely. And from that realization, Ben, with remarkable clarity, then asks the critical question that truly embodies the magic question of the entire book. If a business is worth $1,000, why would anyone sell it to you for $500?
That is the magic question, isn't it? It seems illogical.
It's such a simple, logical, and intuitive question, yet in the context of the often irrational stock market, it's a revelation. Greenblatt emphasizes that unbelievably there's a place where this kind of apparent irrationality happens all the time.
And that place is the stock market.
That place is the stock market.
And here's the unexpected catch, the big secret he tantalizes you with in this very first chapter. Finding these dollar bills selling for 50 cents isn't incredibly complicated. You don't need to be a genius, possess privileged information, or have some kind of superhuman analytical ability.
So what is the catch?
The real catch, as he puts it, is that you, the listener, have to dedicate the time to understand a long story, to truly grasp its implications, and most importantly, you have to believe that this story is true.
Belief. That sounds almost philosophical.
It is, in a way. He states it bluntly. If you don't believe the magic formula will make you rich, then for you it won't. But if you do believe it, deeply and genuinely, then whether you use the formula directly or simply apply its core principles, you are absolutely on your way to investment success. It all hinges on that fundamental belief and conviction in the underlying logic.
Yes, the psychological component of investing is often underestimated, I think. Many otherwise sound investment strategies fail not because they are flawed in their economic principles, but because the investors themselves lack the conviction to stick with them through the inevitable periods of underperformance or doubt.
Right, you bailed too early.
Exactly. Understanding why a strategy works provides that essential resilience. It's the intellectual grounding that fuels patience.
So we've learned the first big secret. Investing is at its heart about figuring out what a business is truly worth. But before we can even begin to invest, we need to understand how money, our money, actually grows. So let's explore Chapter 2, which begins with a humorous but very real look at the absolute worst thing you can do with your hard-earned savings, exemplified by the infamous mattress plan.
Ah, yes, the mattress plan. Indeed, the mattress plan is the most straightforward yet ultimately futile approach to saving. Your money simply sits there, idle, earning nothing. In fact, due to the insidious erosion of inflation, it actually loses purchasing power over time, meaning your dollar buys less tomorrow than it does today.
So you're actually losing money, in a way.
Right. You are, in real terms. Greenblatt illustrates this with his youthful adventures, buying novelty items from a company called Johnson Smith, including a comically oversized weather balloon. While presented humorously, the underlying lesson is profound. The futility of holding on to cash without putting it to work, and the importance of saving for the future rather than squandering money on fleeting pleasures that offer no lasting value or growth.
So he quickly learned that hot air rises, a valuable lesson in physics, if not directly about finance, but it eloquently sets the stage for Plan B, taking your $1,000 to the bank.
Right. Plan B introduces the fundamental concept of compound interest, which Albert Einstein famously called the eighth wonder of the world.
The power of compounding.
Exactly. If you deposit $1,000 in a bank account that pays a modest 5% interest annually, and you let that interest compound over 5 years, your initial $1,000 will grow to $1,276. It's a simple, low-risk way for your money to grow, certainly a vast improvement over the mattress, which yields precisely zero. The key is that your interest begins earning interest on itself, creating exponential growth over time.
And then there's Plan C, which moves us into slightly more adventurous territory. Corporate bonds. This is where you, as an investor, effectively lend money directly to businesses rather than depositing it in a bank.
That's right. Instead of an intermediary like a bank, you can directly buy a bond issued by a company. A large, well-established company like McDonald's, for instance, might offer an 8% annual return on a $1,000 bond held for 10 years.
Okay, 8% is better than 5%.
Clearly more attractive than a bank's 5%, representing a higher potential return. However, this comes with a crucial caveat. Corporate bonds carry more risk.
Right. The company could go bust.
It could. If the company struggles financially, it might default on its interest payments or even fail to return your original capital. This is why riskier, less stable businesses, Greenblatt humorously uses Bob's House of Flapjacks and Pickles, would have to offer even significantly higher interest rates to compensate investors for that increased risk of default. The market demands a greater reward for taking on greater uncertainty.
And this discussion naturally leads us to the ultimate benchmark for risk-free returns, U.S. government bonds. What's their significance here?
Precisely. While nothing in life is truly devoid of risk, lending money to the U.S. government is as close as an investor can get to a risk-free return. The implicit assumption is that the U.S. government will always honor its debts.
Okay, the safest bet.
Pretty much. So if you were to lend money to the government for, say, 10 years, and it offered a 6% annual interest rate, this 6% then becomes your absolute no-risk benchmark.
The baseline.
Exactly. The crucial takeaway for you as an investor is this foundational principle. Any other long-term investment you consider, whether it's a corporate bond, a real estate venture, or buying stock in Jason's gum shops, must offer a potential return greater than this risk-free rate of 6%.
Why take the risk otherwise?
Precisely. Why would you take on the additional risk of investing in a business, with all its inherent uncertainties, if it promised the same or even a lower return than a guaranteed government bond? This simple comparison is a foundational filter for all investment decisions.
So, to quickly summarize Chapter 2, the mattress plan is a guaranteed path to losing purchasing power over time. Bank deposits offer simple compound interest growth, And government bonds provide a critical baseline, acting as your absolute minimum target return for any investment.
That's it.
Any money you put to work in the market, whether in corporate bonds or stocks, must promise a return significantly above that risk-free rate to compensate for the added risk. And of course, always remember that hot air rises.
Indeed.
Okay, now that we've explored the super safe options and established our benchmark for risk, what's the next, perhaps more exciting step we can take with our money? Chapter 3 delves into the core concept of investing in actual businesses, moving from lending money to owning a piece of the enterprise, using an expanded version of our friend Jason's thriving gum empire.
Yes, we return to Jason's gum shops, but now it's evolved from a one-man operation into a full-fledged chain of stores. This expansion is critical to understanding how individual stock investing works. The idea here is that ownership of this larger, more complex business is divided into many small, equal pieces, which we call shares.
Shares of stock, right?
Exactly. For instance, if Jason's business is now worth $12 million and he wants to sell half of it to outside investors, he might divide his half into 1 million equal shares. This will mean each share is priced at $12 a piece.
Okay, simple math.
Right. So $6 million total value divided by 500,000 shares he's selling to the public, though there are a million shares total. If you, the investor, then buy 10,000 of these shares for $120,000, you now literally own 1% of Jason's entire business and are entitled to 1% of its future earnings. You're no longer just lending money, you're a part owner.
And this is where the business's financial performance becomes transparent, right? Jason provides us with an annual income statement for his gum shops, illustrating how the company translates sales into profits.
Exactly. The income statement is crucial because it provides a snapshot of the business's profitability over a period. For Jason's gum shops, we see total sales of $10 million. After deducting the cost of goods sold, which is what it costs to produce the gum, at $6 million, they're left with $4 million in gross profit.
That sounds good.
Then, operating expenses, which include things like rent for the stores, employee salaries, and utilities, account for another $2 million, bringing the profit before taxes down to $2 million.
Okay.
Finally, after a 40% tax rate, the business is left with a net profit or earnings of $1.2 million. This is the money available to the owners.
So with a total net profit of $1.2 million and 1 million shares outstanding, that means each share earned $1.20, 1 M shares.
Correct.
And if Jason is selling each share for $12, our first-year return on investment based on those past earnings would be $1.20 divided by $12, which comes out to exactly 10%.
This 10% figure is what Greenblatt introduces as the earnings yield. It's a direct and powerful metric because it allows for an immediate comparison to the 6% annual return we could easily get from a risk-free 10-year U.S. government bond.
Right, 10% beats 6%. Seems like a good deal.
On the surface, a 10% earnings yield clearly beats 6%, suggesting it's a better deal. It suggests a higher potential return for the risk taken. However, as Greenblatt notes, it's not quite that simple, and this is where the real-world complexities of stock investing begin to emerge.
And this is where the challenges of predicting the future and competing with the best minds on Wall Street really start to pile up. What are the key hurdles the book identifies?
Indeed. The first major challenge is that the $1.20 per share was last year's earnings. As investors, we're buying a share of future earnings. We need to estimate what Jason's gum business will earn next year, or even further into the future.
First of all time.
Pretty much. Will the business continue to grow, decline, or simply stay stagnant? Second, how confident are we in those predictions? Is Jason's gum business a fleeting fad that will quickly lose steam? Will new, more aggressive competition suddenly emerge, eroding his profits?
Lots of unknowns.
Exactly. If our estimates about future earnings are too uncertain, the guaranteed, albeit lower, 6% from a government bond starts to look remarkably appealing by comparison. And third, what about earnings beyond just the next year? Will they keep growing steadily, indicating a healthy, expanding business? Or will the gum business eventually go sour, leading to declining profits? These are complex questions that require deep analysis.
It's enough to make you, the individual investor, panic. Because on top of all those uncertainties about the business itself, you're also competing with armies of professionals. Highly credentialed MBAs, PhDs in quantitative finance, legions of smart financial analysts, and full-time money managers.
All trying to figure out the same thing.
Yeah. All of whom are trying to figure out the exact same things, often with far more resources and data at their disposal. How can you possibly compete with them and win? It seems like an insurmountable task for the average person.
That's the exact daunting question Greenblatt explicitly poses to the listener at this point. He acknowledges that these challenges are undeniably real and can feel overwhelming.
Okay, so he doesn't ignore it.
Not at all. However, he quickly reassures us that while individual stock valuation is complex and competitive, the solutions he offers are surprisingly straightforward and accessible. You don't need an MBA or an advanced degree in finance to beat the market.
That's the promise again.
That's the promise. The important takeaways from this chapter are that buying a share means purchasing a tangible portion of a real business and its future earnings. Valuing a business fundamentally involves estimating those future earnings, and any stock investment you make must promise a significantly higher yield than a risk-free government bond to justify the added risk. The magic formula is designed precisely to cut through this perceived complexity and level the playing field for the individual investor.
So figuring out what a business is truly worth is clearly a challenging, even daunting task. We have to make educated guesses, and those guesses come with significant uncertainty. But Chapter 4 asks a pivotal question. What if you could figure it out? What if there really was a place where you could systematically buy a business for half its true value?
The $500 for $1,000 scenario again.
Exactly. A place where you could reliably acquire $1,000 of value for only $500. This sounds almost too good to be true, given the competitive nature of the market.
This is where Greenblatt transitions to a compelling demonstration he uses with his own business school students. He highlights the perplexing phenomenon of wild fluctuations in stock prices for huge, well-known companies, giants like General Electric, IBM, or General Motors.
Yeah, big, stable companies.
Right. He gives the example of GM shares trading for $30 one day and then rocketing to $68 within the same year. This implies that the entire company's total market value could swing from $30 billion to $68 billion, or back down in a matter of months. Such dramatic shifts in perceived value for established, stable companies seem illogical.
And the central, almost rhetorical question he poses to his students and to us is, how can this be? Can the fundamental intrinsic value of a behemoth company like General Motors truly change that dramatically within the same year? It challenges our very notion of what a stock price represents.
His definitive answer is a resounding, unequivocal no. He explains with clear conviction that it simply makes no logical sense for the inherent underlying value of a large, stable company to swing so wildly over short periods. The production facilities, the brand recognition, the customer base, the management team, these don't radically transform in months.
The business itself hasn't changed that much.
Exactly. This persistent disconnect between a company's true fundamental value and its daily, often irrational stock price introduces Benjamin Graham's brilliant and timeless Mr. Market analogy.
Mr. Market. He's Graham's personification of the stock market itself. A quirky, often irrational, and incredibly moody business partner who shows up at your door every single day.
Exactly. Imagine this. You own a share of a business, and every single day your eccentric partner, Mr. Market, appears. He's either euphoric, offering to buy your share at an inflated price, or deeply depressed and panicking, offering to sell you his share or buy yours at a ridiculously low price.
Manic depressive, basically.
Pretty much. And you, the investor, always have three simple choices. You can choose to sell your shares to Mr. Market at his quoted price. You can buy his shares from him at that same price, or you can simply do nothing.
You don't have to trade with him.
That's the crucial empowering point. You are never required to act. You are the rational one in this partnership, and you only engage when the price is clearly advantageous to you.
So if you've done your homework and you believe GM is truly worth, say, $70 a share fundamentally, but Mr. Market, in one of his depressed, fearful moods, offers to sell it to you for a mere $37, you buy.
Absolutely, that's a gift.
Conversely, if you already own shares and you've assessed their intrinsic value to be perhaps $30, $35, but Mr. Market, in a moment of irrational exuberance, offers you $37, you sell. You're taking advantage of his temporary madness.
Right.
And if it's trading at $37 and you think it's worth $40, $45, you simply do nothing. You wait patiently for a better opportunity. The true power lies in the fact that you, the disciplined investor, are never obligated to transact.
This powerful analogy leads directly to the crucial concept of margin of safety, a cornerstone of value investing. Graham famously advocated for buying shares at a large discount to true value.
Margin of safety, like a buffer.
Exactly like a buffer. If your carefully estimated intrinsic value for GM is $70, but you can acquire it for $37, that significant difference, that $33 per share, is your margin of safety. This margin acts as your protective buffer. It safeguards you, the investor, if your initial valuation turns out to be slightly off, or if the business encounters unexpected headwinds or downturns after your purchase.
So even if you're wrong, you're hopefully not that wrong.
Precisely. Even if GM's true value was closer to $50 or $60, buying at $37 still leaves you ample room to profit and substantially reduces your risk of a permanent loss of capital. It's like building a strong conservative buffer into your investment.
But the immediate challenge, as we explored in our previous discussion from Chapter 3, remains a persistent concern for many. How do you, the individual investor, actually know the true value of a complex business?
Back to the valuation problem.
Yeah. How can you possibly be right more often than you're wrong, especially when you're up against all those brilliant professionals with vastly more resources who are also trying to find these exact same bargains? It certainly sounds like a monumental task, raising immediate skepticism about how this can truly be done by an individual.
It does, and Greenblatt explicitly addresses this potential skepticism head-on. The answer, he reassures us, isn't to outthink every single one of those smart professionals on every individual stock.
Okay, good. Because that sounds impossible.
Right, that's a losing game for most. Instead, the beauty of Mr. Market's consistent mood swings is that irrationality is widespread and constant, meaning genuine bargains are always being created somewhere in the market. The solution isn't about superior individual stock forecasting, but rather embracing a systematic, disciplined approach that allows you to identify and capitalize on situations where Mr. Market is acting irrationally, consistently offering good businesses at bargain prices.
And that systematic approach is the magic formula.
The magic formula is precisely that systematic approach.
So, the stage is perfectly set. We now understand the unpredictable nature of Mr. Market and the absolute importance of finding underlying value in a business, combined with a margin of safety. Now, in Chapter 5, the author reveals the incredibly simple yet profoundly effective tools of the trade that form the core of his magic formula. And he sets it up with a brilliant, universally recognized analogy. The Karate Kid.
Ah, yes, wax on, wax off. The analogy from The Karate Kid is truly perfect for this moment. Daniel, the protagonist, initially believes he's just performing menial, repetitive chores, waxing cars, sanding floors. He sees no direct connection to learning karate.
He thinks Mr. Miyagi is just using him for free labor.
Exactly. Yet, through these seemingly basic repetitive motions, he unwittingly masters complex, intuitive defensive blocks. Greenblatt uses this to illustrate that the two investment concepts he's about to reveal are similarly basic, almost deceptively simple. You might find it hard to believe they could possibly transform you into a stock market master.
Okay, I'm intrigued.
But, like Daniel San, by consistently applying these fundamental movements, you absolutely can achieve mastery and generate superior returns.
That's a fantastic parallel. So what are these two deceptively simple tools? Let's dive into the first one, the wax-on of investment wisdom.
Wax on is the earnings yield. We discussed this earlier with Jason's Gum Shops. If a company earned $1.20 per share last year and its share price is currently $12, that's a 10% earnings yield. $1.20 divided by $12.
I calculated that, yeah.
The core insight here is wonderfully straightforward and intuitive. If you had the choice between buying that same share for $12 when it earned $1.20, 10% yield, or buying it for $12 when it earned $2.40 yield, or even $3.60, 30% yield, all else being equal, you would unequivocally prefer the higher earnings yield.
More earnings for the same price. Makes sense.
Exactly. Why? Because you're getting more earnings, more ownership in the underlying profitability of the business for every dollar you invest. This tool is fundamentally about identifying bargain prices in the market. You want to get the most bang for your buck in terms of a company's actual earnings relative to its stock price. It's about finding businesses that Mr. Market is making available at a genuine discount.
Okay, that's wax on. Finding the bargain price using earnings yield. What about wax off? What's the second powerful yet simple concept?
Wax off is return on capital. This concept shifts our focus from the price to the inherent quality and efficiency of the business itself.
How good is the business at making money with the money it has?
Precisely. Let's revisit our comparison. Imagine Jason's Gum Shops, where it costs $400,000 to build a new store, and that store then earns $200,000 in profit each year. That's an exceptional 50% return on capital. 200,000 earnings divided by $400,000 capital invested.
50% return. That's incredible.
It is. Now, compare that to Jimbo's Just Broccoli. Jimbo also invests $400,000 to build his store, but it only manages to earn a meager $10,000 a year. That's a dismal 2.5% return on capital. $10,000 divided by $400,000.
Ouch. Broccoli isn't as profitable as gum, apparently.
Apparently not. The obvious conclusion here, and the second crucial insight, is clear. A business that consistently earns a high return on capital is fundamentally a much better, higher quality business than one that earns a low return on capital. This tool helps you, the investor, identify good businesses, those that are highly efficient at generating profits from the capital they employ.
And now, for the big finish that Greenblatt promises. The true secret, he reveals, isn't just in understanding these two concepts individually, but in strategically combining them.
Combining wax on and wax off.
Exactly. Buying good companies, meaning those that consistently demonstrate a high return on capital, at bargain prices, at prices that offer you a higher earnings yield. He makes an incredibly bold and compelling claim that this simple yet powerful combination can end up systematically buying many of the good companies that crazy Mr. Market has decided to literally give away.
Good companies at bargain prices.
It sounds almost too elegantly simple to be true, doesn't it?
It does sound incredibly powerful, and the elegance is precisely what makes it so robust. You see, you're not simply chasing cheap stocks, many of which might be cheap for very good fundamental reasons. They could be struggling, outdated, or poorly managed.
Cheap for a reason.
Exactly. Nor are you blindly buying great companies that are often so popular and widely recognized that their stock prices are already inflated, making them poor investments at current valuations.
Paying too much for quality.
Right. Instead, what you're doing is systematically identifying that unique sweet spot. Businesses that are demonstrably fundamentally strong, highly profitable, and efficiently managed, but which Mr. Market, in one of his irrational moods or moments of temporary fear, has made available at a significant discount.
Yeah.
That potent combination of quality and value is precisely what generates superior returns over the long term.
So we're ready for the grand reveal, the magic formula itself in action. In Chapter 6, he knows what you're thinking. A magic formula often sounds like a gimmick, something from an infomercial.
Yeah, the name itself raises eyebrows.
It does. But he immediately establishes its credibility by pointing out that even the legendary Benjamin Graham, widely considered the father of value investing and Warren Buffett's mentor, had his own version of a systematic, formulaic approach.
That's an important historical context. Graham's formula, though he never explicitly called it magic, was revolutionary for its time. It focused on buying companies whose stock prices were trading so low that they were actually cheaper than the cash you'd get from simply liquidating their current assets. He famously referred to these as net current asset stocks.
Buying companies for less than their spare change, essentially.
Pretty much. Graham successfully employed this strategy for over 30 years, generating consistent, safe returns through various market cycles. His approach proved that a simple, disciplined system for identifying obviously undervalued stocks could lead to remarkable, repeatable success and capital preservation.
But Graham's original formula, while undeniably effective in its era, isn't really applicable in today's highly efficient and thoroughly analyzed markets, is it? It sounds like those extreme bargains are few and far between now.
Unfortunately, no, it's largely impractical today. Graham's formula was conceived and implemented during a very different market environment, particularly in the aftermath of the 1929 crash and the Great Depression, when stocks were genuinely priced at incredibly distressed levels.
Unique time.
A very unique time. In today's far more information-rich and competitive markets, very few, if any, publicly traded stocks meet those extremely strict liquidation value requirements. However, the spirit of Graham's approach, the core idea of systematically finding obvious bargains based on quantifiable metrics, remains incredibly potent and timeless. That, Greenblatt argues, is precisely where his new magic formula steps in.
So what is this new magic formula in action, and what kind of results has it actually achieved? This is the exciting part.
Okay, so at its heart, it's a systematic, rules-based strategy designed to consistently find good companies trading at bargain prices, leveraging those two simple tools, high return on capital and high earnings yield.
Wax on, wax off, systematically applied.
You got it. And the historical results are profoundly compelling. Greenblatt tested this strategy over a 17-year period, from 1988 to 2004. A hypothetical portfolio of about 30 stocks, chosen annually by the magic formula, returned an astounding average of approximately 30.8% annually over that period.
30.8% a year for 17 years.
Yep. This stands in stark contrast to the overall market, as measured by a broad index, which returned about 12.3% annually during the same time frame.
That's more than double the market return.
Way more than double. To really grasp the power of compounding, consider this. An initial investment of just $11,000 would have grown to over $1 million with the magic formula.
Wow.
Whereas that same $11,000 invested in the overall market would have only grown to about $79,000.
That is a truly significant, life-changing difference. And he notes in the books afterward that later data shows even more recent confirmation of its efficacy.
He does. The principles seem to hold up.
Wow, that's not just a significant difference. That's an absolute chasm between outcomes. The power of compounding at those rates is truly incredible.
So how does the formula actually go about ranking these companies to achieve such extraordinary results? What are the underlying mechanics you need to understand?
The process is quite elegant and logical. The formula starts with a broad universe of investable companies. For instance, the largest 500 U.S. companies by market capitalization. First, it ranks all of these companies from 1 to 3,500 based on their return on capital, with rank 1 being assigned to the company with the highest return on capital.
So rank 1 is the best return on capital.
Right. So a company with the 232nd best return on capital would receive a rank of 232. Next, it performs the exact same ranking process for earnings yield, again ranking all companies from 1 for the highest earnings yield to 3,500. A company with the 153rd highest earnings yield would naturally get a rank of 153.
Okay, two separate rankings.
Two separate rankings. Finally, and this is the magic step, it combines these two individual ranks by simply adding them together. So a company with a return on capital rank of 232 and an earnings yield rank of 153 would receive a combined rank of 385.
Exactly. 232 plus 153 equals 385.
And that combined rank is how the formula prioritizes companies with the best combination of both factors. Rather than just excelling in one, it's looking for the balanced performer.
Exactly. The formula isn't necessarily looking for the absolute #1 company in either return on capital or earnings yield in isolation. Instead, it seeks the optimal balance. A company that's, say, ranked 232nd in return on capital, which is still exceptionally good out of 3,500 companies, but ranked 153rd in earnings yield, meaning it's also genuinely cheap, would be preferred over a company that's, for instance, #1 in return on capital, but only, say, 1,150th in earnings yield.
Because the second one isn't cheap enough, despite being a great business.
Precisely. The lower the combined rank, the better, as it indicates a superior overall combination of quality and value. This combined ranking system rigorously identifies businesses that are fundamentally strong, but temporarily undervalued by Mr. Market.
And Greenblatt emphasizes that while understanding these mechanics is helpful, the mechanics aren't the important part. What truly matters is your belief in the formula's overwhelming logic and common sense.
Back to belief again.
Yeah. It's not about intricate calculations, but about the conviction that these sensible principles, systematically applied, will work for you over time. So after hearing about those phenomenal historical results, immediate questions naturally spring to mind for any skeptical investor. Where did these numbers come from? Are they trustworthy? Is this just a lucky streak that won't repeat? And what if these amazing opportunities simply disappear once everyone knows about them? Chapter 7 addresses these critical doubts head-on.
These are absolutely valid and necessary questions for a discerning investor. First, regarding company size, Greenblatt rigorously validates that the formula's stellar results weren't simply skewed by selecting only tiny, illiquid, or obscure stocks that individual investors might struggle to buy.
Right, the small cap effect.
Exactly. The initial study, which generated the 30.8% annual return, ranked the largest 3,500 U.S. companies. Even the smallest of these had a market value over $50 million, making them readily accessible to individual investors. But to further bulletproof the findings, he tested it on even larger companies.
Okay, what did he find?
For the largest 2,500 companies, those with over $200 million in market capitalization, the formula still returned an impressive 23.7% annually against the market's 12.4%.
Still crushing the market.
Yep. And for the largest 1,000 companies, those with over $1 billion market cap, which were accessible even to massive institutional funds, it achieved a still remarkable 22.9% versus the market's 12.4%.
Wow.
This consistently strong outperformance across different size tiers powerfully confirms that the principle holds, regardless of the company's size or liquidity.
That's incredibly powerful evidence. It's clearly not just a small cap anomaly, which is a common concern with certain investment strategies. But the idea of luck always lingers. Could it simply have been an incredibly fortunate streak, a random occurrence over those 17 years?
Highly, highly unlikely. The study covered a substantial 17-year period, with a disciplined portfolio rebalancing every year. A portfolio of roughly 30 stocks held for 1 year each translates to over 1,500 different stock picks for each of the 3 size tests.
For each size group?
Yeah, for the largest 3,500, 2,500, and 1,000 companies. Cumulatively, that's over 4,500 separate magic formula selections over the 17 years.
That's huge sample size.
Massive. With such a massive sample size and consistent application over nearly 2 decades, attributing the sustained, significant outperformance to mere luck becomes statistically improbable to the point of being virtually impossible. It's a testament to the underlying systematic logic rather than chance.
And what about the concern that those bargain opportunities, those companies that Mr. Market is practically giving away, might just disappear once the formula becomes widely known? Will Mr. Market simply wise up and stop creating these deals?
That's where the compelling decile analysis comes in.
Oh.
Researchers took the largest 2,500 companies and ranked them meticulously by the magic formula, from the very best, highest combined rank of quality and value to the very worst, lowest combined rank.
Okay.
They then divided these companies into 10 equal groups, or deciles. Group 1 contained the top 250 companies, the best combination of good business and bargain price. Group 10 contained the bottom 250, poor businesses at expensive prices.
So best to worst.
Exactly. When they tracked the returns of these deciles over that 17-year period, the formula worked remarkably in order. Group 1, the best ranked, significantly outperformed Group 2. Group 2 outperformed Group 3, and so on, all the way down to Group 10.
Like stair steps.
Precisely. In fact, the best ranked group, Group 1, beat the worst ranked group, Group 10, by over 15% per year.
15% difference between the best and worst groups annually.
Yeah. This consistent ranking in order demonstrates that the formula isn't just finding a few rare, elusive bargains. It's systematically identifying a consistent spectrum of quality and value throughout the market. This implies that there will always be top-ranked stocks available because Mr. Market's mood swings are eternal, and his irrationality continues to create opportunities across a wide range of companies.
That ranking in order is particularly compelling evidence, isn't it? It suggests you're not reliant on hitting a tiny, elusive target, but rather leveraging a broad, consistent market inefficiency. This robust validation then powerfully sets up the truly critical question for our next segment. How do we know the magic formula will continue to work in the future, even with all this information out there? So we've seen how impressively the magic formula has performed in the past and how robust its methodology is across different company sizes and against the idea of sheer luck. But as the book points out in Chapter 8, history is full of examples like the British Revolutionary War. A strategy that worked perfectly well in one context, or when known by only a few, can utterly fail if the context changes, or if everyone knows about it.
Right, like the redcoats marching in straight lines. Didn't work so well against guerrilla tactics.
Exactly. So how can we be confident the magic formula will continue to work, even after it's been revealed to the world?
This is where Greenblatt delivers what he ironically, yet profoundly, calls really good news. There are plenty of times when the magic formula doesn't work at all.
Wait, that's good news. That sounds terrible.
It sounds counterintuitive, even alarming, but it's the absolute key to its enduring power and why it will continue to work. Let's look at the statistics of its underperformance. The magic formula portfolio, despite its incredible long-term track record, underperforms the overall market in about 5 out of every 12 months in any given year.
Almost half the time in any given year.
Roughly. For full-year periods, it underperforms roughly 1 out of every 4 years. What's even more telling, and a true test of an investor's resolve, is that for 1 out of every 6 tested periods, the magic formula portfolio underperformed the market for more than 2 years in a row.
2 years straight of underperforming. Ouch.
And critically, even within the wildly successful 17-year test period we discussed, there were stretches where the formula endured 3 years in a row of underperformance.
3 consecutive years of underperformance. That is truly brutal, especially when it feels like everyone else around you is making money or the market is soaring.
It's incredibly difficult psychologically.
It speaks to the enormous psychological challenge of sticking with a strategy when it's not delivering immediate positive results or when it's even losing money. He shares anecdotes in the book that truly resonate. A best-selling author whose mutual fund, based on a rigorously proven formula, struggled for years, causing clients to abandon it.
Right before it took off, probably.
Likely. Or the story of the smartest money manager I know, whose clients, after years of underperformance, pulled their money just before his strategy ultimately achieved extraordinary market-beating results. It's a testament to how human emotion can sabotage even the most logical plans.
These stories powerfully highlight the fundamental human challenge of patience and unwavering conviction in the face of adversity. It is incredibly difficult, emotionally and psychologically, to stick with an investment strategy that is losing money or significantly underperforming, especially when the financial media, your friends, or your own inner doubts are constantly whispering that you're doing it wrong, or that this magic simply isn't working.
That constant doubt must be corrosive.
It is.
Yeah.
And this inherent difficulty in enduring short-term pain is precisely the self-correcting mechanism that Greenblatt describes for the magic formula. If the formula worked perfectly and consistently beat the market all the time, every single month and year, then naturally everyone would use it.
And the bargains would vanish instantly.
Exactly. This massive influx of capital into the same bargain stocks would immediately push their prices up, effectively eliminating the bargain and thus the opportunity. The unavoidable periods of underperformance act as a crucial filter, ensuring that most people won't wait that long. Their lack of patience preserves the efficacy of the formula for those who do stick with it.
So the fascinating paradox here is that the very fact that it doesn't work all the time, or rather doesn't work consistently in the short term, is precisely what allows it to continue working so effectively for those with the discipline to stick with it over the long run.
It's a brilliant self-regulating system.
It really is. This really powerfully underscores the vital role of your belief in the formula's underlying logic, coupled with a genuinely long-term investment horizon for the magic formula to work for you. Without that deep conviction and the patience to endure, you will almost certainly abandon it before it has a chance to deliver its promised extraordinary long-term results. Let's move to Chapter 9, where the author works to solidify that absolutely vital belief in the formula's timelessness. He begins with a rather humorous, albeit obscure, memory device from his youth. Vomit under the 3M spaces and run.
Huh. I remember reading that. What was that even for?
It was a mnemonic for learning letter placement in a print shop, a skill now entirely rendered useless by modern computers. He contrasts this kind of ephemeral, outdated skill with truly timeless principles, like the law of mathematics. 2 + 2 always equals 4, regardless of the century.
Right. Math doesn't go out of style.
Exactly. He frames the magic formula's core principles as similarly timeless and fundamentally sensible, immune to fads or technological shifts.
That analogy perfectly sets the stage for reinforcing conviction. For the magic formula to sustain an investor through those inevitable periods of underperformance we just discussed, its core principles must be not just logical, but profoundly timeless and rooted in fundamental economic truths.
Makes sense.
The formula, at its essence, is systematically helping us do something that always makes sense in business. Find above-average companies that we can buy at below-average prices. This simple, undeniable statement is the bedrock of its enduring logic, transcending market cycles or technological advancements.
So let's break that down, as it's truly the intellectual core of the strategy. Why are companies that consistently earn a high return on capital considered good businesses or above average? What makes them special?
Businesses that can consistently find ways to invest their money and generate an exceptional annual return on that capital, like Jason's Gum Shops, achieving a 50% return in our earlier analogy, are truly pretty special. The vast majority of individuals and businesses simply cannot achieve, let alone sustain, such high rates of return on their invested capital.
It's hard to get a 50% return consistently.
Extremely hard. This inherent ability to generate a high return on capital means the company has an incredibly valuable opportunity. It can reinvest its substantial profits back into the business at these very high rates, which then leads to accelerated compounding earnings growth. For example, if Jason's Gum Shops earns $200,000 and can reinvest that entirely into a new store that also earns 50% on capital, its earnings could theoretically jump to $300,000 the very next year. That's a 50% growth rate.
Wow, that's powerful growth.
This ability to compound capital at high rates is immensely valuable to shareholders and signals a fundamental competitive strength.
But wouldn't that kind of extraordinary success and high profitability inevitably attract intense competition? In a capitalist system, wouldn't new entrants eventually drive down those high returns to average levels, negating the advantage?
You're absolutely right to ask that. Capitalism is indeed designed to do precisely that. Competition tends to erode abnormal profits. However, companies that can maintain a high return on capital over extended periods, despite competitive pressures, likely possess what economists call a sustainable competitive advantage, or what Warren Buffett famously refers to as an economic moat.
A moat around the business castle.
Exactly. This could manifest as a genuinely new and innovative product, an incredibly strong, irreplaceable brand name like Coca-Cola.
Right, people pay more for Coke.
They do, despite many beverage competitors. Or it could be a superior distribution network or a powerful network effect like eBay, where the value of the service increases as more people use it. This enduring advantage acts as a powerful barrier, preventing competitors from easily eroding those high returns down to mere average levels. The magic formula, by systematically selecting companies with consistently high returns on capital, is effectively identifying businesses that possess these hidden or undervalued competitive advantages.
And what about the other side of the coin? High earnings yield translates quite literally to bargain prices. How does that reinforce the common sense logic?
Correct. After identifying these inherently good businesses, those that demonstrate a proven ability to earn a high return on capital and possess some kind of competitive edge, the formula then applies the second filter. It looks for those same good businesses that Mr. Market, in his irrational moods, has temporarily made available at a bargain price.
Good business plus cheap price.
That's the mantra. The simple, undeniable common sense of buying above-average companies identified by high return on capital at below-average prices identified by high earnings yield is what provides you, the investor, with the deep conviction and intellectual grounding needed to stick with this strategy through thick and thin. It just makes fundamental, indisputable business sense, and that conviction is what ultimately drives long-term success.
Let's talk about something a little different for a moment. I love sailing. I'm not particularly good at it. Once almost got flattened by a barge, which was a very memorable learning experience.
Sounds exciting.
It was something. But there's a real enjoyment in the process, even without being an expert. And I think that sense of enjoying the process and trusting in the underlying mechanics can be applied to investing. In Chapter 10 in the afterword, the book gives us even more good news about the magic formula's incredible track record and how it effectively redefines what we typically think of as investment risk.
Indeed. The author intentionally held back some of the most compelling performance data until this point, waiting until he had thoroughly explained why the formula works, not just that it did work.
Saving the best for almost last.
Pretty much. He reveals some truly remarkable statistics regarding the formula's consistency. Over the 17-year study period, when analyzing all the rolling 3-year periods, the Magic Formula portfolio beat the market averages an astonishing 95% of the time. That's 160 out of 169 such periods.
95% of the time over 3-year rolling periods. That's amazing.
It is. But more remarkably, for all 169 of those 3-year periods, the Magic Formula portfolio generated positive returns 100% of the time.
Never lost money over any 3-year period.
Correct. The worst 3-year return achieved by the Magic Formula was a gain of 11%, which stands in stark contrast to the S&P 500's worst 3-year loss during that same period, which was a devastating 46%.
That is an absolutely astonishing difference. A minimum gain of 11% versus a potential loss of 46% for the broader market. That redefines what risk means. And for the largest 3,500 stocks, it gets even better.
Even better. The Magic Formula consistently beat the market averages in every single 3-year period tested.
Every single one.
Every single one. That's not just remarkable. That's unprecedented consistency in the world of investing.
Okay, my mind is a little blown.
It truly is. And this consistency leads us to a crucial redefinition of risk for you, the individual investor. Most academic measures of risk can be complex and often don't intuitively resonate with real-world concerns. Instead, Greenblatt proposes 2 simple, practical questions regarding risk. What is the risk of losing money over the long term, and what is the risk that your chosen investment strategy will perform worse than reasonable alternatives over the long term?
Makes sense. Will I lose money? Will I do worse than just buying an index fund?
Exactly. By these 2 pragmatic measures, the Magic Formula demonstrably achieved better results with less risk than the market averages. It consistently made money and outperformed even during market downturns, offering a powerful blend of superior returns and capital preservation.
But that still leaves the Mr. Market problem. If he's so emotional, fickle, and irrational in the short term, how can we be absolutely sure he'll eventually come to his senses and pay a fair price for our bargain purchases?
Right. How do we know the price will ever go up?
Yeah. How do we know we won't simply be stuck holding these deeply undervalued assets indefinitely, waiting for a payoff that never comes?
This is the second vital piece of wisdom and reassurance from Chapter 10. While Mr. Market is indeed emotional and irrational in the short term, driving prices to absurd lows or highs, over the long run, it's a completely different story. Mr. Market gets it right.
Mr. Market eventually smartens up.
He does. Greenblatt is so confident in this fundamental principle that he guarantees his MBA students that if they accurately value a company, Mr. Market will eventually, almost inevitably, agree with them. And this usually happens within a reasonable time frame, typically 2 to 3 years.
2 to 3 years. Okay, that requires patience, but it's not forever. So how does that price correction happen? What are the inherent market mechanisms that ensure these temporary bargains eventually revert to their true fair value? It can't be just wishful thinking.
Absolutely not.
Oh.
Several powerful forces work in tandem to ensure that value eventually wins out. First, astute and patient investors, the ones who truly understand and believe in the underlying value, will eventually recognize these persistent bargain opportunities. Their sustained buying activity will gradually but surely push the stock price towards its fair value.
Smart money steps in eventually.
Right. Even if general uncertainty or temporary emotions keep most buyers away for a while, the fundamental strength of the business will eventually become undeniable, and rational assessment will prevail. Second, companies themselves may actively buy back their own shares if they believe their stock is undervalued. This reduces the total supply of shares, increases demand, and helps push the price up towards its intrinsic value.
The company itself sees the bargain.
Yep. And third, if a bargain persists for an extended period, it makes the company an attractive target for acquisition. Another company or a large private investment firm might decide to acquire the entire undervalued business, driving the share price, often quite rapidly, to its fair value. All these fundamental market forces, Greenblatt asserts, ensure that bargain purchases will be rewarded over time.
So your patience and your unwavering commitment to a long-term horizon are not just virtues, but absolutely critical ingredients for harnessing Mr. Market's eventual rationality. It's not about predicting his short-term whims, but trusting that fundamental value will ultimately prevail.
That's the essence of it. Trust the process. Trust the value.
Now, after all this talk about the profound logic and impressive results of the magic formula, let's address the elephant in the room for many aspiring investors: the perceived necessity or even desire to pick individual stocks on their own outside of a systematic approach. Chapter 11 delivers a truly blunt warning about this, and it's quite a memorable one.
Oh yeah, the dynamite factory one.
Exactly. Choosing individual stocks without any idea of what you're looking for is like running through a dynamite factory with a burning match. You may live, but you're still an idiot.
It's a stark but crucially necessary caution designed to grab your attention. The reason this warning is so potent lies in a nuance of the magic formula itself. The formula works by using last year's reported earnings to calculate the earnings yield and return on capital for a company.
Right. Backward-looking data.
Exactly. While this works incredibly well on average for a diversified portfolio, for any single individual company, relying solely on last year's earnings can be very misleading. The very reason Mr. Market has undervalued a company and given it a high earnings yield might be that its near-term prospects or its current situation actually are poor.
The market might be right about that one stock being cheap for a reason.
It might. The bargain is there precisely because there's something currently unattractive about it. If you're picking one stock and that something truly impacts its future, you could be in trouble.
So what's the big, almost shocking conclusion for most of us, given that danger?
The strong, undeniable conclusion Greenblatt arrives at for the vast majority of individual investors is this: if you, the investor, cannot reliably predict a company's normal future earnings and accurately value businesses on your own, then quite simply, you have no business investing in individual stocks on your own.
Wow, that's blunt. No business doing it.
It's a bold and somewhat provocative statement, but it underscores the immense difficulty of accurately forecasting an individual company's future performance and intrinsic value. The magic formula, conversely, works because it leverages the power of diversification. It picks a portfolio of 20 to 30 stocks.
Safety in numbers.
Precisely. For such a large and diversified portfolio, last year's earnings often serve as a remarkably good proxy for the average normal earnings across many companies, even if it might be misleading for any single one. You're not relying on the specific future of one stock. You're seeking the extraordinary average result of the formula's selections.
But for those rare, truly expert investors who can do that deep valuation work, is there a different, more concentrated approach they might consider?
Yes, there is. For the very, very few investors who are genuinely capable of accurately estimating a business's normal earnings years into the future and performing deep, independent valuations, a highly concentrated portfolio of, say, 5 to 8 stocks carefully selected across different industries can indeed be a safe and highly effective strategy.
The Buffett approach.
Essentially, yes. This is the realm of investors like Warren Buffett. However, Greenblatt is quick to acknowledge that this is an extremely rare skill, honed over decades of dedicated study and practice. For everyone else, for those who still feel the urge to play the stock-picking game but wisely recognize they aren't experts, he offers a sensible compromise strategy.
Okay, a middle ground.
Sort of. Choose 10 to 30 of your personal favorites, but only from the top 50 to 100 companies ranked by the magic formula. This approach intelligently blends the systematic selection, which provides a strong probabilistic edge, with a touch of personal choice, while still leveraging the formula's core strength of identifying good businesses at bargain prices.
So you get the formula's help but still feel like you're picking.
Exactly.
Yeah.
A bit of the best of both worlds, perhaps.
This chapter truly drives home the point that for most people, the disciplined, systematic, and diversified approach of the magic formula is not just one option, but likely the only intelligent and reliable way to consistently outperform the market over the long term. Let's face it, when it comes to investing, many of us, perhaps unconsciously, harbor a hope for a magical helping hand. We imagine someone on Wall Street who's truly looking out for us, ready to guide us to riches. But as Chapter 12 humorously yet bluntly warns, there ain't no tooth fairy on Wall Street.
Love that line.
The core message: you're ultimately on your own, and understanding that is your first step to true financial independence.
This analogy is absolutely critical for disabusing you, the individual investor, of the notion that there's some benevolent entity on Wall Street whose primary purpose is to make you rich or to give you unbiased, perfect advice. Most investment professionals, while perhaps well-intentioned on a personal level, operate within a system of incentives that are often misaligned with your best interests.
Their goals aren't necessarily your goals.
Often not. Stockbrokers, for instance, are typically paid fees based on the volume of transactions they execute, or on selling you specific products, not necessarily on your long-term investment success. Their primary incentive is often to generate activity, not necessarily to maximize your capital.
So if stockbrokers, with their transaction-based incentives, aren't the answer for consistent outperformance, what about mutual funds, which pool money from many investors and are managed by supposedly expert professionals? They seem like a more accessible solution for diversification.
Mutual funds initially appear to be an ideal solution for smaller investors seeking diversification and professional management. However, the data is unequivocal. After factoring in their management fees, trading costs, and other administrative expenses, the vast majority, over 80% of actively managed mutual funds, consistently fail to beat their respective market averages over time.
80% fail to beat the market. That's dismal.
It is. Moreover, relying on past performance to pick a winning mutual fund manager is a notoriously flawed strategy. Historical success rarely predicts future returns due to a host of issues, including the difficulty of a fund scaling its winning strategy as it grows larger, frequent changes in fund managers, and the sheer statistical unlikelihood of sustained outperformance against an efficient market. You're essentially betting against very high odds with high fees to boot.
And what about the exclusive world of hedge funds, which are often touted as the ultimate sophisticated investment vehicle for the ultra-wealthy?
Hedge funds are typically reserved for very wealthy investors, often requiring minimum investments of $500,000 or even millions. They also charge truly substantial fees frequently, a 1% management fee on assets under management, plus a hefty 20% of any profits generated.
2 and 20, the classic model.
Exactly. While they do have more flexibility in their investment strategies than traditional mutual funds, the chances of finding a truly great hedge fund manager who consistently justifies those exorbitant fees, after all costs, are exceedingly slim. Thousands of hedge funds have been created over the years, but only a tiny fraction deliver exceptional, consistent value that makes them worthwhile beyond the fees. You're paying a premium for a very uncertain outcome.
So if stockbrokers, mutual funds, and hedge funds don't reliably beat the market after fees, what's left for the average investor who simply wants a solid, consistent return?
This landscape leads many financial experts to recommend low-cost index funds as a default option. An index fund simply aims to replicate the performance of a specific market index, like the S&P 500, by owning all the stocks in that index, and it does so with very small management fees.
Just buy the market, basically.
Essentially, while this strategy won't help you, the individual investor, beat the market, it will merely match it, minus those tiny fees. It ensures you achieve market average returns. And historically, over the last 80 years, the average stock market returns have been over 10% per year, which, compounded over decades, is not too bad at all, as Greenblatt dryly notes. It's a very solid, low-effort outcome.
But the whole driving force behind this deep dive, and indeed Greenblatt's book, is to show you how to do better than just average. So after ruling out all these conventional Wall Street avenues, the author delivers the punchline with a characteristic wink. If you want to beat the market consistently and reliably, there's only one good alternative left, and it rhymes with magic formula. He goes on to promise that implementing it won't even take much work, just minutes every few months. It's a powerful call to action.
Yes, the logical progression leads directly back to the systematic, disciplined approach of the magic formula. It's designed to empower the individual investor, sidestepping the inherent conflicts of interest and inefficiencies that plague so much of Wall Street. It simplifies the complex investment process by providing clear, actionable, and remarkably effective steps that leverage documented market irrationality.
And now for the absolutely crucial part, the step-by-step instructions for implementing the magic formula. This is where we turn all that powerful theory and compelling historical data into concrete, actionable steps for you, our listener, to apply in your own investment journey. What are the key considerations before we dive into the specific actions?
Okay, the practical stuff. The overarching goal here is to easily and reliably reproduce the formula's excellent past results. First, and this is non-negotiable for success, you need to hold a sufficiently diversified portfolio of at least 20 to 30 stocks.
20 to 30, okay.
Yeah.
Not just 5 or 10.
No. The magic formula works on average across a broad portfolio, so holding many stocks helps to smooth out the inevitable individual stock volatility and ensures your overall portfolio performance stays true to the formula's documented average results over time. Second, each stock should generally be held for a 1-year period.
Hold for a year.
Right. And for those investing in taxable accounts, there's a smart tax adjustment. Sell losing stocks a few days before the 1-year mark to capture those losses as short-term capital losses, which can be fully deducted against ordinary income, up to certain limits.
Tax loss harvesting.
Exactly. Conversely, sell winning stocks a few days after the 1-year mark to qualify those gains for lower long-term capital gains tax rates. This minor timing adjustment can significantly boost your after-tax returns, effectively putting more money back in your pocket.
And when you're first starting out, you don't just dump all your money into 20 or 30 stocks at once, right? It sounds like there's a more measured approach.
Correct. While getting started is often the hardest part, it's wise not to purchase all 20-30 stocks simultaneously. To replicate the original test results and smooth out your initial entry points, you should ease into your magic formula portfolio over your first year.
Stagger the purchases.
Right. This means adding 5 to 7 stocks to your portfolio every 2 to 3 months until you gradually build up to your target of 20 to 30 stocks. After that initial year, as individual stocks hit their 1-year holding period, you simply sell them. You then use the proceeds from these sales, combined with any additional money you wish to invest, to buy an equal number of new magic formula selections, effectively repeating the buying process. This consistent rebalancing is key.
Okay, so with those foundational considerations in mind, how do we actually find these magic formula stocks? What are the precise, practical steps you, the investor, need to take to implement this, starting with the recommended and easiest option?
There are a couple of excellent options, but the most straightforward and highly recommended one, which Greenblatt himself provided, is to use his dedicated website.
Let's detail option 1, using magicformulainvesting.com.
Okay, step by step. Step 1. The first step is simple. Go directly to magicformulainvesting.com. It's designed to be user-friendly and intuitive.
Easy enough.
Step 2. Once on the site, follow the clear instructions to choose your preferred company size. For most individual investors, selecting companies with market capitalizations over $50 million or $100 million is generally a good starting point, as these are typically liquid enough for EV trading.
Choose your universe.
Step 3. Follow the site's prompts to generate and display a list of the top-ranked magic formula companies. The website does all the complex calculations for you, providing a ranked list ready for action.
The formula does the work.
Step 4. From this top-ranked list, buy 5 to 7 of the companies. To manage your initial investment and spread out your purchases, only allocate about 20% to 33% of the total money you intend to invest in the formula during your very first year. For example, if you plan to invest $30,000 in your first year, you might buy $6,000 to $9,900 worth of stocks in this first batch.
Don't go all in at once.
Step 5. This is where the staggering comes in. Repeat step 4 every 2 to 3 months. This staggered approach means that after approximately 9 or 10 months, you will have gradually built up a fully diversified portfolio of 20 to 30 stocks, spreading out your entry points into the market.
Build the portfolio gradually.
Step 6. After holding each individual stock for 1 full year, sell it. Remember the crucial tax adjustments for taxable accounts. If a stock is a loser, sell it a few days before its 1-year anniversary to ensure it's a short-term loss for tax purposes. If it's a winner, sell it a few days after the 1-year mark to qualify for lower long-term capital gains tax rates.
Sell winners after a year, losers before. Got it.
Then immediately use the proceeds from these sales, plus any additional new money you want to invest, to buy an equal number of new magic formula selections from the updated top-ranked list, repeating step 4 for those new purchases. This creates a continuous discipline cycle.
Reinvest and rebalance. Step 7. This is arguably the most critical and non-negotiable step. Continue this entire process for many years. You must be committed to this strategy for a minimum of 3 to 5 years, regardless of short-term market fluctuations or temporary periods of underperformance.
The patience part again.
Yeah.
Minimum 3 to 5 years.
Absolutely. If you don't have that long-term commitment and the mental fortitude to stick with it through thick and thin, Greenblatt warns, you are highly likely to quit before the formula has a chance to work its documented long-term magic. Patience is the ultimate virtue here.
Okay.
Step 8. And, he adds with a characteristic touch of humor, feel free to write and thank me.
Hopefully you'll have reason to. That's incredibly clear and actionable, and the website makes it so straightforward. But for those who might prefer using other general screening platforms like iia.com or similar financial data providers, what are the general instructions to approximate the magic formula's criteria? Right. If you're using a general stock screener, here's how to approximate the magic formula. First, use return on assets, ROA, as your primary proxy for return on capital. Set a minimum ROA of 25% to filter for highly efficient, profitable businesses.
ROA minimum 25%.
From that filtered group, then screen for stocks with the very lowest price earnings, PE ratios. The PE ratio is the inverse of earnings yield, so a lower PE means a higher earnings yield, indicating a bargain price.
Lowest PE for the bargain.
Next, explicitly eliminate all utility companies and financial stocks. This includes mutual funds, banks, and insurance companies from your list. These sectors have unique accounting and capital structures that can distort the formula's metrics.
No utilities, no financials.
Also, remove any foreign companies from your list. These are often identified by the suffix ADR, American Depository Receipt, after their stock ticker. The formula works best with U.S.-based companies due to reporting consistency.
U.S. stocks only.
Finally, exercise a bit of caution for stocks with extremely low PE ratios, say 5 or less, as this can sometimes indicate unusual, one-time, or outdated earnings data that isn't representative of the company's normal profitability. You might also want to filter out any company that has announced earnings in the last week to avoid untimely or potentially misleading data before analysts have fully processed it.
Be careful with super low PEs or just reported earnings.
Right, just a bit of common sense filtering. Once you have your refined list, simply follow steps 4 through 8 from the magicformulainvesting.com instructions we just outlined. The core discipline of staggered buying, annual rebalancing, and long-term commitment remains precisely the same.
So we've covered the fundamental principles, the incredible track record, and the step-by-step practical methods for finding these good companies at bargain prices and investing consistently. But in Chapter 13, the author shifts gears profoundly. He poses a very different, deeply personal question to you, listener. What would you do if you had a lot of money? He wants you to think beyond basic needs and luxuries, to ponder the higher purpose of wealth.
This chapter represents a powerful transition from the mechanics of personal investing to the ultimate purpose and broader societal implications of wealth. He subtly, yet effectively, reinforces the immense power of compound interest without explicitly boring you with statistics.
Less math, more meaning.
Exactly. He uses incredibly impactful hypothetical examples. If you contributed just $28,000 over 6 years into a retirement account, achieving a modest 15% annual return could transform that into over $325,000 in 20 years.
Wow, from $28K to $325K.
Stretch that out to 30 years, and that same $28,000 could become $1.3 million. And if you achieve higher, but historically achieved, rates like the magic formula's 25% annual return, that initial $28,000 could compound to a staggering $13.4 million in 30 years.
$13.4 million, that really drives home the power of time and returns.
It does. The magic formula's past returns are actually even better than some of these examples, vividly illustrating the immense life-changing power of sustained compound growth.
He even delivers a direct, almost humorous don't do it warning, particularly aimed at younger listeners, about squandering even small amounts of money. Why? Because if you, from a young age, truly understand how a seemingly insignificant 25-cent stick of gum, if wisely invested, could theoretically turn into more than $200 by the time you reach middle age, it fundamentally shifts your mindset.
Every little bit counts, exponentially.
It really does. It cultivates a profound appreciation for the power of saving and investing from an early age, preventing casual squandering of even small sums.
Exactly. It's about recognizing the exponential potential of even the tiniest sums when given time and consistent compounding. While Greenblatt is always careful to clarify that past performance doesn't guarantee future results, he firmly reiterates his belief that the magic formula will remain one of the very best investment alternatives available to individual investors and will continue to handily beat market averages over time if you maintain that unwavering commitment and discipline.
And this leads directly to a profound, overarching thought. Beyond simply accumulating personal wealth, what's the higher purpose? He mentions his deeply held personal philosophy of asking his MBA students to find some way to give back. He extends this powerful invitation directly to you, the listener, as you potentially build significant wealth through these principles.
This is truly a powerful shift in focus. He suggests that while diligently engaging in stock investing can indeed be incredibly lucrative, the sheer time and effort invested isn't always the most productive use of human capital for society as a whole.
Interesting point. There might be better ways to spend your time making a difference.
That's his suggestion. He then offers a truly provocative thought by applying the very same return on capital concept, which is central to his investment formula, to broader societal issues, specifically the often debated education system. A good education system, he argues, is unequivocally a high return on capital investment for society.
Investing in people pays dividends for everyone.
Exactly. It nurtures future entrepreneurs, develops a skilled workforce, fosters innovation, and ultimately drives economic growth and prosperity.
And he contrasts this with what he provocatively calls the Jimbo's Just Broccoli public school system, drawing a direct parallel to the inefficient business model.
The 2.5% return on capital model.
Right, where poor performance is not penalized and capital isn't reallocated efficiently to better performing areas.
He draws a direct, stark parallel to the brutal efficiency of capitalism. In a business, if poor performance persists and fixes don't work, the business eventually fails. Its capital is then liquidated and redirected to more productive uses, to businesses that can generate a high return on capital.
Creative destruction.
Right. But in many public school systems, he points out, poor performance often doesn't lead to genuine consequences for individual teachers, administrators, or entire schools. As a result, money isn't efficiently reallocated to programs or schools that demonstrably achieve higher educational returns on that capital.
Lack of accountability hinders efficient capital allocation.
That's the argument. He concludes by suggesting that any truly lasting solutions for education reform, whether implemented through charter schools, vouchers, or other structural changes, must fundamentally address this inherent lack of consequences and incentives for performance. Investing effectively in education, in this sense, offers an incredibly high, impactful return on capital for society, far beyond mere financial returns.
So it's not just about making money for yourself, but about recognizing how those same fundamental principles of efficiency, accountability, and generating a high return on capital can be profoundly applied to create a better world, making a real and lasting difference in society.
A very thought-provoking conclusion.
What an incredible journey we've taken today, unlocking some truly powerful insights from the little book that still beats the market. To recap, the core message, elegantly simple yet profoundly impactful, is clear. Successful investing is about fundamentally understanding what a business is truly worth, systematically seeking out good, high-quality businesses that Mr. Market, in his temporary irrationality, is offering at bargain prices.
Good companies at bargain prices.
And perhaps most crucially of all, embracing the vital importance of unwavering patience and deep belief in a proven, long-term, systematic strategy like the magic formula.
The tools themselves are simple, the underlying logic is undeniably sound, and the historical results are exceptionally compelling. This deep dive into Greenblatt's work should provide you with a powerful sense of empowerment, giving you the knowledge and the practical steps to take control of your own financial future.
Yeah, I feel like you can actually do this.
Absolutely. Remember, the hardest part isn't learning the steps or understanding the logic. It's maintaining that unwavering belief and disciplined commitment through the inevitable ups and downs that Mr. Market will undoubtedly throw your way. The true magic is in your perseverance.
So as you go forth, armed with this newfound wisdom and understanding, we leave you with the lingering, provocative question that Joel Greenblatt himself poses in the book. What will you do with all that money you potentially amass? And more importantly, how will you choose to make a meaningful difference in the world, applying these same principles of high returns to the causes and communities you care about? Use these principles, apply them wisely, and truly enjoy the journey.